The CCM market models have shown significant improvement relative to the outlook over the coming weeks. But as we'll outline in this video, setups remain in place for a possible pullback in risk assets. As we noted last week, we've seen significant technical improvement in the global markets and in the credit markets. The CCM market risk model closed Friday at its best level since mid-October, which is bullish. However, we also see similarities coming off a bottom to June 20th and July 3rd of this year. Since a picture is worth 1,000 words, this is a daily chart of the S&P 500. Our market models have readings that are similar to a significant bottoming process. However, we also see similarities to this period here in June, where we had a 53-point give back from this point to this point in the S&P 500, and similarities to early July, where we had a 49-point drop in the S&P 500 from this peak to this trough here. If we can break out of resistance that we cover later in the video, it's possible that we'll move into somewhat of a melt-up look like this. In the video, we'll tell you what to look for. We just have to keep an open mind. As we noted last week, Europe still faces long-term resistance going back to 2007. We'll provide updates to what are tired DeMark counts. We'll also provide numerous levels that you can use to monitor risk on and risk off this week. We've been adapting to the risk on shift. We've been net long for some time. On Friday, we did take some short-term profits off the table in technology stocks. We'll remain flexible and nimble. We've got triangles in many markets, so visualize a resistance line and a support line in a triangle formation. And what that means is you can get sell signals and then in close proximity get buy signals. So even though our models are improving and the markets are improving, we have to respect risk-off resistance. And until it's cleared, we'll remain flexible and nimble. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a 60-minute DeMark chart for the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies, LLC. Why are we looking at a 60-minute chart? If you follow us on Twitter or read our blog, Short Takes, which you can find on our website, you know that we took some profits off the table on Friday. Numerous reasons for doing that. We're still bullish longer term, but concerned about the risk-reward ratio in the short term. This is an upside propulsion target for the S&P 500. We're sitting basically right on it. It was 1416.30. We closed Friday at 1416.18. We also have an active 913. I know this looks messy in here, but this is a 9 paired with a 13 and a 9. A 9, 13, 9 is more concerning than a 9 and a 13 in isolation. It's even more concerning when it occurs near a propulsion target. We also have these probabilistic targets here at 1420, 1421, and 1425 that could act as potential resistance early in the week for the S&P 500. The real concern is, from a risk-reward perspective, we've met, for the most part, this upside target of 1416. If we were to reverse here, your downside target is 1374. Now, we're not saying we're going to 1374. You also have potential support in DeMark speak at 1413. TDST line, which tends to be pretty strong support in a bull market, 1401. This yellow line is somewhat of a momentum bull-bear demarcation line at 1396 and change, call it 1397. What it says is, when you drop below the green, the probability increases of getting to the yellow, and when you drop below the yellow, the probabilities increase in terms of moving towards the red at 1374. Moral of the story, until this is cleared up and this chart improves, the short-term risk-reward ratio for the S&P 500 is concerning. Still bullish longer term. We want to see this cleared up. We want to see what happens with those European ETFs that we'll discuss later in this video. Last week we showed this chart with closing prices only. You can get a little bit better feel for the long-term resistance that many European indices, including the German DAX index, are facing. This is a peak in October of 2007. Resistance acted as resistance again in 2011. Notice this is a red arrow and this is an orange arrow. It's yet to be determined what happens here. And you can somewhat see the triangle formations we just talked about here. Risk on, resistance, risk off, risk on, risk off, risk on. Until these triangles in numerous markets are cleared, we have to keep an open mind and be extremely flexible. Buy signals can quickly be followed by sell signals. Buy signals, sell signals. At some point, this will be resolved in either a bullish or bearish manner. This is a daily chart of the FEZ ETF, the Euro Stoxx 50 Index. This is the chart we visited last week. Last week we had a 4 here and a 12. We said we had a deferred 13 count. A 9 and a 13, if you're not familiar with DeMark, can signal potential trend exhaustion, higher probability for reversal when you have a 9 and 13. Notice I use the term potential and the term probability. A 9 and 13 for our time frames in and of themselves are not bearish. What they tell us is to pay attention, and if the market and the technicals, including the DeMark indicators, continue to confirm or align with this 913, we're ready to pay attention. We don't necessarily take action until we see a little bit of confirmation from this 9 and 13. So what we have is we have a 9 and a 13 and a second 9. This is the standard sequential count. This is the risk level, which is somewhat of a DeMark stop loss level. So if I decided in DeMark speak to short FEZ here, and I went short, I would potentially cover my short in an oversimplified way if it ticked above 33.87. More has to happen in the DeMark world, but the probability of this 9 and this 13 being a good signal is highest when FEZ does not exceed this risk level at 33.87. Formally, a break above it does not invalidate this, speaking purely in probabilities. So how do we use this? We're bullish right now. This is telling us to be a little bit careful, a little bit measured here. We'll be watching this level here. As long as FEZ stays below 33.87, we'll continue to be careful. Above 33.87, we'll be more open to FEZ moving higher. I said this was the standard sequential count. Let's look at the aggressive sequential count because it's actually a little bit more concerning. On this count, you have a 9 paired with a 13, and the 13 came on November 29th. We also have a new 9 that occurred on Friday, November 30th. So in DeMark speak, we have a 9, 13, and a 9. A 9-13-9 is even a more bearish setup or has a higher probability of a reversal than a 9 and a 13 in isolation. Why this count differs, the 9 here, the second 9 came after the completion of this 9 and this 13. The risk level's at the same level at 33.87. So anyone can watch 33.87 on FEZ in the coming days to help them in terms of probabilities of higher highs and probabilities of a potential reversal. If you've watched our videos in the past or are familiar with DeMark, you know DeMark has 4 standard counts There's a sequential, an aggressive sequential, a combo, and an aggressive combo. Let's look at the combo count. The combo count leaves the door open for FEZ to move higher. Standard combo is on a 9-6 and a 9-6. It would take at least 7 trading days to get to a 13. The aggressive combo count, similar vein, leaves the door open to potential higher highs. All the counts are relevant to us. The reason why we're gravitating towards this count, which is the standard sequential count, is combo counts are designed for strongly trending markets, ones that are ripping higher. Sequential is designed more for a market that we have here, which is more of a high and then a series of retests or retest. However, if we continue to trend in a strong manner here, then the combo count on this side would become potentially relevant. Now we're looking at another DeMark tool known as propulsion. These are known as magnets. You can think of them somewhat as targets, probabilistic targets. 3450 is a good number to write down on FEZ if you want to track this. On the downside, if the 9s and the 13s come into play, 2938 is the number to keep in your back pocket. Now we're looking at TD lines. We mentioned last week that TD lines are DeMark's trend lines that are drawn in an unbiased and systematic manner, unlike trend lines that we draw as humans. We always draw trend lines with bias, whether we think we're drawing them with bias or not, and that includes when I draw trend lines. That's why I like these DeMark trend lines. This is bullish here. This tells you this solid line that this is expected to be a good breakout. So this leans bullish here. Really why I wanted to show it. This is another probabilistic target here, and this would align with the combo count that would allow the market to rise for as many as 7 additional trading days. The target there, and the one to watch, is 3532. Now these targets can change over time, but this is where they sit as of the close on Friday, November 30th for FEZ, the ETF. Just want to make one point here on this weekly chart of the S&P 500 risk on relative to the VIX or the fear index risk off. So risk on divided by risk off. This is what risk on looks like. This is what risk off looks like. If you've been following us, you know we developed the market risk model in Q1 of this year. We're very, very pleased with how the market risk model is helping us make better decisions in this risk on, risk off world where one day the markets are plunging and the next day they're skyrocketing higher. If you want to learn more about the market risk model, you can go to our homepage at shavacocapital.com, click on this video image, and then you can watch this video. The basic slant in this week's video tends to be bearish, but the longer term picture is bullish. On this chart, here are some bullish developments. The ratio moved above the red and the blue moving averages. Moving average turned up, that's bullish. MACD histogram ticking up tends to be bullish for risk. It's somewhat indecisive here, but for the most part it's ticking up. The point we want to make here, this is risk on resistance, stocks dropped. Risk on resistance for the ratio, stocks dropped. Keep in mind this is a weekly chart, so that's a fairly significant drop. Resistance for the ratio, stocks dropped. Last week the ratio came up and the same line acted as resistance. The way we use patterns is we pay attention to them until they're no longer in place. In terms of this chart, it appears that the pattern is still in place. If this ratio breaks out next week, that's fine. We just like to see it happen. Bullish evidence. This is IWM ETF, the Russell 2000 small caps. Tends to be good when IWM is above these moving averages, the red and the blue. It's also bullish when we get this moving average crossover. Also bullish when the slope of these moving averages turn back up. We have some of that trying to form here. Price above both of the moving averages, similar to this region here or here. Slopes of the moving averages trying to turn up. Another potentially bullish development is support for risk on seems to have held here. We broke this trend line here, support, 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 but now we're back above it. Williams percent R tends to be good when it gets back above negative 50. We did that last week. So longer term, this chart leans bullish and is one of the reasons why the CCM market risk model has shown marked improvement over the past 2 or 3 weeks. This is another chart that's shown bullish progress but does have some indecisiveness factored in as well. This is IYM Basic Materials. You can see as of the close on November 30th, closed above both moving averages. That's a good sign. That's somewhat similar to this period here and this period here. The indecisiveness comes in where the moving averages are flat. We'd like to see them turn up. And we also have potential resistance here, resistance here. It acted as resistance right here below the red arrow. We're back there again. So this chart leans bullish longer term. There are some concerns short term. We'd also like to see a bullish MACD cross, which we don't have yet. Keep an open mind. We'd like to see this chart get here. Even better would be if we can move above this line here in the days and weeks ahead for IYM, Materials ETF. This is another chart we follow. We showed this last week. This is longs, SPY divided by shorts. Risk on relative to risk off. This is what risk on looks like. This is what risk off looks like. Points we made last week. It's good or favorable or bullish when the ratio clears the moving averages and the moving averages turn up. That's a bullish cross here. Ratio has cleared them. Black above red and blue, bullish. Ratio's turning up. And we do have a bullish cross. All looks good. Just keep in mind, we had all of that here in June, and we did get a pullback in stocks. We see some similarities to this period here. This is bullish, RSI above 50, bullish. Just have to be open to this type of potential pullback here. And when we pull back, we want to remain above the moving averages, and we'd prefer to have the moving averages with positive slopes. So if we come down, we'll keep an open mind and just see what it looks like. Right now, this looks pretty good. Just quickly, if you didn't see this, this is our blog, Short Takes, on ShabacoCapital.com here up in the left-hand corner. This is just another reason here why we're a little bit concerned and why we took some QQQ profits off the table. This is QQQ risk on divided by TLT risk off. There is a resistance line here. We could break out in a manner like this, which is quite possible with what we've seen, but we don't want to guess. So this is a good spot to reduce risk, a good spot to reduce risk, potentially a good spot to reduce risk. If we break out, there'll be plenty of opportunities on the other side of this, especially if those DeMark counts that we'll cover later in the video are taken out on the upside. Also, just to have some concerns, you can draw trend lines with the Commodity Channel Index, CCI, support, support, support. What once was support now can act as resistance. The blue line, we've met that line again on Friday's close. Also have this upward sloping trend line that acted as resistance here and here. They intersect here. One of two things is going to happen. We'll either get a strong bullish break next week, which we will happily participate in. We're still net long. We just reduced risk last week, took some profits off the table, or we'll bounce back down here on these resistance levels. We'll keep an open mind. We don't need to know what is going to happen. We just need to understand the risk-reward ratio relative to where we are now. It will change if we get on this side, or if we bounce back this way, we may get an opportunity to redeploy cash at lower levels. We mentioned last week that several European ETFs had tired-looking counts quickly. This is EWQ. This is France. We have a 9 paired with a 13. 13 came on the 29th. An additional 9 came on the 30th. This one looks a little more troubling in that the 9 and the 13s are coming closer to this propulsion target. The figure that you can watch on propulsion for this ETF is 2306. The risk level associated with this 9 and this 13 is 2290. If you're a bear, you would prefer 2290 to remain as resistance and not be exceeded. If you're a bull, you'd like to see 2290 exceeded. Same goes here. If you're a bull, you'd like to see EWQ trade over 2306. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.